But we started looking at the example, and what we're going to do today, so let me just warm everybody up and let you know where we're going. This is on page 10. Today we're going to continue this example by focusing on an income statement approach to accounting for deferred taxes. Then we're going to move into the balance sheet approach, compare them, and then we'll talk about what we're going to be doing on Thursday. So if you look up at the screen, you'll see that we had a company with the acquisition of a $300,000 asset. The asset is going to be depreciated on a straight line basis for GAAP purposes, no scrap value over a 6-year period, so that the GAAP depreciation is always going to be $50,000. That's under the straight line basis. For tax purposes, we already talked about this on last week. We're using MACRS, and those are the amounts that would be depreciated each year. Tax rate is 40%. Tax rate's 40%. What we'd like to do is use an income statement perspective to determine the deferred taxes, tax expense, and of course tax payable for the period of the asset's life. So if we go down now and look at, I'm going to leave that up on the screen. If we look at the table, I know we started looking at this, table on page 11, this table now will focus on the income statement methodology, where we're going to take each year, look at the book tax differences, determine the tax provision, as well as the deferred liability. Under the income statement approach, we calculate the tax provision, which is the income statement effect, and add that on the balance sheet. So in the yellow highlighting, you see that the provision itself is the income statement effect, where the cumulative, the summation of those provisions become the deferred liability on the balance sheet. Now again, in this case, we have a situation where we're using straight line on our books, or for GAAP purposes, and we're using an accelerated method, the MACRS, which we said last week that we are familiar with, so that in the early years, we now have built up a tax advantage. In my notation, the tax advantage is in parentheses. I can't guarantee that's the way you're going to see it all the time. Some companies put assets in parentheses. Some companies put liabilities in parentheses. However, looking at the first year, you'll notice that if I have MACRS depreciation for $60,000, $50,000 on my books, I have a tax advantage equal to $10,000. That tax advantage will save, at 40%, it'll save $4,000. However, we know that we've got a tax advantage today, but those amounts will become taxable. Now, some of the things we're going to look at today, and there's a lot of material in these modules that I don't cover in class because you got to read them. And the terminology is a future taxable amount. This becomes a future taxable amount because when we get to the reversal period, we're going to wind up getting a tax disadvantage, and we have to pay back the taxes. So in the first year, I have a tax advantage equal to $10,000. At a 40% tax rate, it saves me $4,000, but it becomes taxable when reversal takes place, and I've got to pay back the $4,000. Next, in year 2, I'm able to take $96,000 for tax, $50,000 for books. I have an excess tax depreciation of $46,000 that at a 40% tax rate will save $18,400. That $18,400 will be paid back after reversal takes place when we get into the tax disadvantage period, and therefore my liability is now 22.4. Want to show this again. The provision is the change on the income statement. The cumulative liability is on the balance sheet. So the yellow is the income statement provision, the additional tax expense, and the green is the deferred liability on the balance sheet. Now, of course, this will happen again in year 3. And notice that if I take the first 3 years that I have right now, I'm going to highlight those in, let's say, blue. Those are the originating book tax differences. And now in year 4, we start to get the reversal. And I'll put those in yellow. The reversal means we have to pay back the tax. So let's just take year 4, for example. In year 4, 34,560 is your tax deduction, but I could have, had I been using straight line, I could have taken 50. So I just lost a valuable tax deduction that is equal to 6,176. It's a lost tax deduction, I'm sorry, 15,440. That lost tax deduction will cost 6176 in additional taxes, and when I pay that, which I will pay this year, it reduces my liability to 19,264. Next year, the same thing. The lost tax deduction in yellow, the reversal of 15,440, cost me 6176 in additional taxes paid, and it reduces my liability down to 13,088. And then finally in the last year, I have a loss of 32,720, lost tax deduction. That will cost an additional 13,080. When I pay that back, I will completely pay off my deferred liability. Now, the deferred liability, the way you look at this, I think, is to say that when these book tax differences reverse, I am going to be paying back the previously deferred liability. So in the reversal period, I pay back the previously deferred liabilities. Now, to give this more, I guess, substance, we're now going to assume that income before depreciation and taxes is always going to be 400,000. So that's my assumption. And that's for both book and tax. Or for GAAP and tax. Exactly the same. So when we look at the income statement, or I'm sorry, the tax return. On the tax returns, let's see what's happening. First of all, tax return, this is something I always say to be careful with when you're doing problems or exams. You got to make sure you use the tax depreciation. Move that up a little bit if I could. So you always have to try to get to the tax depreciation. I don't know why this is falling on me. I'll just keep it sideways. It's easier. All right. So in year 1, you've got 400,000 of income. Tax depreciation, as you can see from the MACRS table, is 60. Taxable income's 340. At 40%, that's my tax payable. Year 2, tax is based on 96,000 of depreciation, and as a result, for that year, I would pay 40% of the 304, and I got the 121.6. And this continues. Now, what I want you to notice is that when you look at the tax payable all the way through, it's going up, correct? Why? You're losing tax deductions. Now, does it make sense to have an increasing tax expense? Just again, let's think about this from the standpoint of preparing financial statements for a financial analyst. The analyst knows 3 things. 1, tax rate is constant at 40%. Depreciation's constant at 50,000. Income is constant at 400,000. Why should the tax change? It shouldn't. It should be the same. In fact, let me scroll over to this for a second. If you look at the income statement for every year on page 12, you'll see that tax expense has to be constant. You have to normalize tax expense. If income before tax and depreciation is always 400,000, if depreciation's always 50,000, and if the tax rate's always 40%, you need to show a normalized or a constant tax expense. Now, how do you do that? Well, we do that through deferred tax accounting. Because if you go back now to the income statements, how do we calculate tax expense? Tax expense is the sum of the current plus the deferred provision. So what's happening is that every year the accountant will take the current provision, which is the tax payable, the 136. To that they're going to add the deferred tax provision. And the deferred tax provision, as we showed you earlier, and I'll put this up on the screen also, is going to be 4,000. Deferred tax provision is 4,000. The current 136 plus the deferred of 4 gives you the tax expense of 140. Year 2, I take the payable, the current provision of 121.6. I add to that the deferred provision, and again, I get tax expense of 140. And this continues. Now, in years 1, 2, and 3, these are the originating differences. In years 4, 5, and 6, we start to get the reversals. And in these reversals, notice what happens. If I take the tax payable of 146, 176, and I add to that the deferred provision, I'm now adding, or pretty much subtracting, I should say, because the payable is a credit, or which was part of the increase in the liability. Here, I'm reducing the deferred liability. In this case, the 6176, I'm in the tax disadvantage period. What I'm doing, when I pay the government the 146, 176, I'm paying back for current economic activity, which is the 140, plus I pay back the previously deferred liability. So I owe the government 146, 176. 140,000 of that is for current GAAP economic activity, and the 6176 is due to paying back the prior liability. So I'm paying back a previously deferred liability. So when you give the government, you have to give them a check for 146, 176. 140 is for your GAAP income, 6176 is for your previously deferred liabilities. Same thing happens in year 5 and in year 6. Once again, you owe the government 153,088, but you got a reversal. You lose the tax benefit of 13,088, got to pay it back, and once again, you'll pay the government more than the tax expense on your books. Your tax expense is always constant at 140, but the payable will vary. The difference between the payable and the amount that you expense on your books is your deferred provision. And once again, as I said, you want to have a constant tax expense to match with book income. Every single year, and again, we're looking at an income statement perspective now, every year, if income is constant, so is the tax expense. And finally, the journal entries, and then we'll take some questions. This is a standard illustration. So that when you have and this should be deferred tax liability. I changed it in the other class for a question. Doesn't matter, but I'm sorry? The deferred tax liability is the cumulative balance. The provision is the change. The provision is the income statement effect, and the liability is the cumulative balance sheet effect. So going back to well, no, you're changing the liability. I understand that. But the provision, the term provision, means the change. It's the income statement effect. It's the change in that liability. Yeah, I know. I mean, right here? Yeah, it's got to say liability because that's where the account is going. Yeah, I mean, if you look at the T account, every line item in here is the provision, but it's going into the liability. So year one's provision is $4,000. Year two deferred provision is $18,400, but the liability is $22,400. So that when you look at these entries, in the originating differences, you debit tax expense every year for $140, you credit payable or cash for $136, and then your deferred liability is credited for the provision, the change in that account. And I had another really good question on the first group about the effect of deferred taxes on the cash flow statement. I mean, when you look at the first journal entry, let's assume that you paid that in taxes. In operating activities, your net income is going to be reduced by $140, but the deferred tax provision is a non-cash expense, correct? So look at that first entry. The deferred tax provision is a non-cash expense. And basically what you're doing here, I mean, if you really wanted to look at this and say, all right, I've got income tax expense, and let's say that's cash. You notice I put cash in there, and that's why I had that question that I wanted to answer. Let's say you paid cash. If you wanted to make two entries, which is not always, never actually, really you never see it, so basically what you're doing when you make that first entry in year one, you're really debiting tax expense for $136, crediting cash, and then you set up the deferred provision by debiting the tax expense and crediting the DTL. So this is an example of splitting that into two entries. So the DTL is really a non-cash expense, and it's just like depreciation, so you add it back in the statement of cash flows. So it's really, the provision is a non-cash expense that gets, and again, the term deferred taxes, as I said, is not really a good way to look at it. It's really accrued tax. You're really accruing more tax. And in year two, same story. You debit tax expense, you credit the tax liability for $121,600, credit the deferred liability. Year three, you also build the liability. So once again, in the originating years, if you look at the liability account, the provision builds up that liability to $25,000 for 40. Then when you get into the reversal period is going to have, let me just change that, more tax paid than the expense. So you debit tax expense for 140 in year 4, but then you debit the DTL because it's being reversed. So now in the reversal period, you'll start to see this come off. So you debit the DTL in this case. So the provision is a debit this time. And you notice that when you pay 146,176, you're paying for the expense related to current economic activity, or the 140, and you're also paying off the previously deferred liability. So again, you do that again in year 5, and in year 6, same thing, but the number goes to 13,088. So these reversals are going to be reducing the liability. So the deferred provision will reverse out, and in a perfect textbook world, with no other complications, that will go to 0. All right. So that is a basic or a foundation deferred tax example. Now, obviously it's got no bells and whistles to it. There are no tax rate changes, no deferred tax assets, no deferred tax asset valuation allowances, which we'll talk about, and no permanent differences. There are no permanent differences in there either. But because it is a base question, I need to know if you have any questions. So any questions regarding the deferred taxes in this example? Any questions about the entries, the calculations, the provision on the deferred tax? Anything on the reversals, anything on originating? And remember, the term originating and reversal doesn't mean debit and credit. An originating is the first direction the account takes. Reversal is the change in that direction. Now again, tax expense is normalized. It matches with book income. This is the income statement perspective. The amount you pay the government is based on the tax return. The difference between the two is the deferred liability. Okay. All right, now just one last thing before I go to some questions. If you wanted to, using a sort of an income statement focus, and you're going to find there's lots of text in here that I'm not going to go over. I want you to read it because it's got a lot of, I think, information that you need to internalize to really understand what you're doing. And from time to time, I'm going to put in something like this, sort of a rubric or a memory jogger that will help you get through this. This is what you really need to understand. You'll all be able to get through a problem by practicing them. Whether you understand it or not is another issue. I want you to understand it, but you can look at it. I could give you a depreciation question just like that one, and you'll be able to do it. But are you going to be able to handle a footnote in practice if you see it? So when I look at footnotes, I really don't know that much about tax, but I do know that if I use the traditional income statement approach, and I note that, for example, if book revenue is greater than taxable revenue, do I pay more or less tax today? Just looking at this, just one box. Yeah, I'm paying less tax now. I got a future taxable amount. Future taxable amount gives rise to a liability. So using an installment sale for tax purposes would result. I accrue it for book, installment for tax. If my revenue is greater for tax purposes, I'll pay more tax today. It's like a prepayment, and I have a deferred tax asset. Why is it an asset? I get future tax deductions. Future tax deductions. Same thing here with a warranty or bad debt. If I take an expense on my books I can't take for tax purposes, I wind up, warranty example, a deferred tax asset. I get future tax deductions. So future tax deductions are assets. future taxable amounts are deferred liabilities. So again, you got to read this through, really try to internalize it. Again, the basic examples we do in a textbook, and you'll be able to do one or two of them and figure out how to handle it. Whether or not you understand it at a client or whether you're analyzing financial statements will be another story. Now, of course, this is the income statement approach, which is, to me, the only way that I really understand. I always have to start, like when you think about a tax return, what do you talk about? Revenues, income, and deductions, correct? You don't talk about assets and liabilities. Well, unfortunately, when we get to the balance sheet perspective, we have to look at this asset liability approach, this basis approach, where we wind up thinking about tax expense, deferred taxes, based on the differences between how we value an asset or liability for tax purposes versus how we value a tax asset or liability for GAAP. And it's going to become more and more comfortable as we go along. But I'll give you a perfect example. What if on your books you have an asset, PP&E, for GAAP, $200,000. For tax, this is the book value. Tax basis, as it's called. All right. Now, not something you're all going to be able to do now, but you're going to have to do this in practice. Is that a deferred tax asset or a deferred tax liability? Let's think about it. What I have to do, I'll be honest with you, what I have to do is flip the switch and think about expenses. So I'm going to be depreciating this asset. Where do I get more expense going forward? Where am I going to get more expense going forward? GAAP or tax? GAAP. So if I have more expense for GAAP, I'll have less expense for tax. Will I pay more tax in the future or less? More, because I'll have a lower tax deduction. Therefore, if I'm going to pay more tax in the future, I've got a deferred liability. So this is going to give rise to a DTL. Because I have lower future tax deductions. Or more future taxable amounts. Now I'm going to show you some things, obviously. I'm not going to just leave this, but that's the way taxes are now viewed. By the way, this was done in Europe for 50, 60 years. We just caught up about 10 years ago using this approach, a balance sheet perspective. These are known as future taxable amounts. Okay? All right, we will see some examples of that later. So once again, if I have a lower tax basis, it means that I've already used up a lot of tax deductions, correct? I've already used them up. Not going to have that many in the future. I'll have more taxable amounts, more tax to pay in the future. More future tax to pay, less today, more in the future is a deferred liability. I mean, just by looking at that, I can't get it, but I've got to go back and think about an expense somehow, or a revenue somehow. Okay. Now, some of these questions, that's what they're really asking here. So, I mean, I'm going to ask you one question, but I'm just going to show you some of these. So if you look at number one, it says a deferred liability represents an increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the year. Those are future taxable amounts. Well, I basically just told you that. That's the definition of a deferred liability, and that is true. These are all definitions. Number 3, deferred tax assets represent an increase in tax refundable or benefits because of deductible, I should say. And that's right, because tax assets mean that you're going to have future tax deductions. I'll give you a perfect example of that one. What about a bad debt? I'll give you another example with this basis thing. The NRV of accounts receivable. For GAAP purposes, the accounts receivable are $100 after deducting the allowance for bad debts. For tax purposes, the receivables are $350. I've already deducted the bad debt expense. I've already deducted the bad debt expense from here. I can't deduct the bad debt for tax purposes until what happens? The accounts are actually considered to be uncollectible. This is going to give me a future deductible amount. Because I have future tax deductions, this situation is what? A deferred tax, future tax deductions, future benefit, asset. Right. All right. Now, a lot harder than expenses, right? A lot harder than expenses. So here's one. So therefore, here in number 5, I could ask this question. Examples of, and by the way, you got to watch, I took these all from CPA exam questions. It says examples of taxable temporary differences are subscriptions and advance rental collections. Now, if I receive subscriptions in advance, and if I receive rents in advance, I pay tax on them immediately. It's a tax asset. It's a future tax deduction, not a future taxable amount. All right, so that one is, 5 is definitely going to be false. All right, so now, so again, basically to answer this question, subscriptions and advance rental collections are deductible amounts. They're future deductible amounts, not future taxable amounts. All right, now, here's the question I have. I'm going to ask you this one. On the next page, number 3. This one is going to help me now be sure we understand, and this is doing, by the way, this is using the revenue and expense, the traditional approach, but nonetheless, this is a CPA question. 40% tax rate doesn't matter here. I just want to know which one of these will give rise, or how many, there could be more than one, couple of situations that give rise to a deferred liability. So I want to know which one of these, could be more than one, give rise to a deferred liability. So let's just see what we get. Okay, so let's see. All right, so yeah, I think they look good. Yeah, it's actually, yeah, C is correct on that one. That's right. It's good. Okay, and let's see why. All right, the first one, revenue is deferred for financial reporting, but not for tax. Here is an example of an advance collection or a subscription received in advance, insurance received in advance. A lot of insurance premiums collected in advance have to be considered taxable. You pay more tax today. Number one is a deferred tax asset. Number one is a DTA. All right, so this first one is a deferred tax asset. Okay, revenue is deferred for tax purposes, but not for financial reporting. An example here would be using an installment method for tax, but an accrual for books. So you accrue everything today, but you wait till you collect it for tax purposes. So that's certainly a DTL. You pay less tax today. An expense is deferred for financial reporting, but not for tax. Expense something for tax purposes before book, you pay less tax today, you pay more later, right? If you pay less, it's temporary, it's got to reverse, so that's going to be a DTL. An example there would be, for whatever reason, using accelerated depreciation on your books, straight line for tax, for whatever reason. And that would be a DTL, so that's the right answer. And the last one, an expense is deferred for tax purposes. By the way, this one is really common. This is warranties, bad debt expense, anything you cannot deduct immediately for tax purposes. So warranty cost, bad debt expense, and that gives rise to a DTA. Okay? All right. All right, so since everyone, or at least 88% of you got that right, hopefully this helps. Again, there's going to be lots of little memory joggers that I'm throwing in here as we go along. Lots of text, lots of scenarios you read with tons of examples to help you get your arms around some of these concepts. All right, so any other questions on the first module? Because that was the traditional income statement approach. We're now going to move toward a balance sheet approach, which will actually result in a lot of the same information, but we'll show you a couple of reasons why it's significant and could be different. All right, so let's go Module 2. Let me get to the first page. All right, so what we want to do here is look at this balance sheet perspective, basis perspective. It's sometimes known as the asset liability method. You also see it as just a liability method. Regardless of the term, it is a focus on a balance sheet. Once you focus on the balance sheet, you trade off the income statement. So that, I know I mentioned this back in Intermediate 1, the trend is now a balance sheet focus. So the goal is to properly value assets and liabilities at the cost of proper matching. So we don't worry as much about matching anymore. Before, about 10 years ago, the SEC and the FASB had a concerted effort to smooth income. And we're going to see a little bit of that smoothing coming through in pensions. It's still hanging around, and there's a good reason for it, because just imagine pension and health care costs. If you had to estimate your liability, so Rutgers will pay, that could be removed too. There was a point, I didn't pay for any benefits here, so who knows. But right now, if I retire, they pay health care costs for me. Now, how much is it going to cost them? Who knows? I mean, 1% increase in healthcare costs, their liability, the Rutgers liability, could shoot through the roof. They'd have to debit an expense and credit an estimated liability if healthcare costs go up. That can swing millions of dollars for companies. So we still smooth out pension and post-retirement benefit costs. We still have that goal. But for the most part, our focus is now moving away from income smoothing and properly valuing the asset and the liability. By the way, for pensions, what we're going to find out, the liability for pensions was so sorely or so badly estimated. It was so understated. Like General Motors had like $70 billion off balance sheet. Now we put it on balance sheet, and the balancing entry, where would the balancing part of that entry go? if I credit a liability for General Motors pension liability, what do I debit if I don't want it to go on the income statement? What's the sort of the wild card accountants have now, not to put things on the income statement? Comprehensive income, other comprehensive income, OCI. So that's how we do it in pensions. We basically don't mess with the income statement, but we'll dump it into stockholders' equity. Anyway, we'll get there. Now, here are some of the side effects of the balance sheet approach. Tax rate changes. When tax rates change, we have to revalue deferred assets and liabilities. So when a tax rate goes down, let's say you got a DTO, when the tax rate goes down, we have to now think about what do we owe the government. Before, if I owed the government future taxes based on 40%, now the tax rate goes up or goes down. Let's say it goes down to 30%, I owe them less. How do I reduce the liability? Debit or credit? Debit. DTL. Where am I going to flow the adjustment through? Well, it's going to go through income tax expense. If the tax rate goes down, I owe less money and I reduce tax expense. And this is a prospective adjustment. So tax rate changes are going to cause volatility in tax expense. The same thing is going to happen with, we'll talk about balance sheet classifications, but the same thing is going to happen with the deferred tax assets. We'll take a look at permanent differences as well, because right now we're looking at temporary differences, and then there is a key footnote that you have to be aware of, and that footnote is a reconciliation of the federal tax rate to the effective tax rate. So we're going to get there. All right, now, what I need to do first is I want to adjust this example. Let's go back to our original illustration. We've got our book tax differences. I'm going to leave this up here. And right up on the board right now, you'll see the same illustration we had before. The company is depreciating the asset $50,000 for book. It's using the modified accelerated cost recovery system. It has constant income of $400,000, and originally the tax rate is going to be 40%. Now, the problem is going to be the tax rate. We're going to assume that the tax rate is going to change at some point, but right now I want to look at changing the way we account for this from the income statement to the balance sheet approach. And let me just take the first 2 years. So when we look at year 1 and 2, and we've got the book tax difference. Let's move this over. No, let me do it this way. All right, so let's do year. Just want to do the first 2 years. And the depreciation is straight line on my books. And the second column is MACRS for tax purposes. We've got 50,000. I'm just going to copy this so I know I have to change the screen in a minute. So after 2 years, you would have depreciated the asset by 100. And you would have depreciated the asset at 156. And of course, the cost of the asset, as we say in the narrative, is 300. Okay. The book tax difference in the first year is 10. And the second year is 46, I think. Yeah, it's 46. Just want to be consistent. The provision, deferred tax provision, and the deferred tax liability. And that provision's at 40%. Okay, so the provision's at 40, and it's 4,018.4. All right, so this is what we did from the income statement approach. This is the way we handled it. We took the book tax difference times the tax rate to get the deferred provision. The sum of the deferred provision became the deferred liability as we went along. Now, here's the basis approach. Before we do anything on tax rate changes, here's the basis approach. Now, you're going to say, I don't see any difference. Well, you're not going to get a different answer. It's a different approach. But there could be significant differences. So, the cost of the asset is $300. In year one, depreciation is $50 for book, $60 for tax. The carrying value of the asset for book purposes is $250, for tax purposes is $240. Now, once again, I've already depreciated the tax basis more, so I have fewer tax benefits or fewer tax deductions. I have more taxable amounts. That book tax difference is 10, and I get a 40% rate. And again, you got to be real careful here. This is the cumulative liability. So when you use the balance sheet approach, you actually focus on the liability, and the change in that liability is the provision. Now, if you only do 1 year, you can't see this. But it's really saying I started with no liability, now I have 4, so the provision is 4. Now, where you really see it is in the second year. When you do the second year, you've depreciated the asset 100 at the end of the 2-year period, and for tax, you depreciated it by 156. The book value for GAAP is 200. The tax basis is 144. The cumulative book tax difference is 56. Now, notice, again, this is something, if you didn't pick this up the first 3 weeks or 4 weeks of the accounting program in the summer, it's a problem. It's cumulative. It is a balance sheet number. 40% of 56 is the liability. That is not the provision. It is the liability. So the balance sheet focus gets you to the liability, but to get the provision, you got to take the difference, which you see in the narrative. So the book tax difference is 56. And again, why do I have a liability here? Well, I have a liability because I'm going to have future taxable amounts. I'm going to lose tax deductions because the asset is lower in terms of its basis. So the difference between the two is that the balance sheet approach is going to focus on the liability, and then you need to do something, that is, you have to take the change, which is right here, to get the provision. So again, nothing tremendously difficult, but just a different approach. So now you're saying, okay, all this for nothing, I might as well just tune out because I'm going to use the income statement approach. Well, yeah, I guess you could do that, and I do mention the difference in perspective, but here's where, and I'm not sure what's going to happen this summer. I'm not doing I would do this if I was covering the advanced accounting, but when you have a merger deal, this can be very critical. Right now you're not getting any difference, but in a merger deal, it's going to become extremely critical. And in the merger deal, it depends on whether or not the deal is considered taxable or non-taxable. Now, probably this summer, in the corporate tax, you may see some of the taxes on corporate reorganizations, and that includes a merger and acquisition. A merger and acquisition could be taxable, or it could be a tax-free transaction. Now, for GAAP purposes, and let's say for tax purposes, let's say the net book value of the net assets is for the subsidiary. You got a subsidiary that has net assets at net book value of 100 for GAAP and 100 for tax. Now, although it was not on the test, we do have the topic of the complex equity method, which will be on the final, I'm sure, if it wasn't on exam 2. Complex equity, what do? We mimic consolidation, which was a essay question. So we do mimic consolidation. How do we do that? We revalue the assets, probably up. They could go down. I mean, don't forget the Bear Stearns building that was sold to Chase was sold below its market value. But basically, you're going to write the assets up. If the deal is tax-free, if it's a tax-free reorganization, then on the revaluation, the tax basis stays the same. Tax-free. You don't get the write-ups for tax. Now, question, based on the little exercise we just did a few minutes ago, is that going to now create a tax asset or a tax liability? The carrying value of the assets for book, or 120, the tax basis of the asset, just assume it's one asset, a plant asset, a factory that I'm going to depreciate. It's on my books for 120. For my tax, it's only valued at 100. Is that a tax asset or liability? Liability, right. Because you have fewer tax deductions, you got future taxable amounts. This now will create on the acquisition date, it creates a liability that didn't exist before. If you don't use the basis difference, you're not going to get that liability. That liability is recognized by using the basis perspective to calculate deferred taxes. So on the date of the acquisition, now you have a liability to recognize that you didn't have to recognize before. Now what happens? The net assets of the sub change. Does that change goodwill? Yeah. So it changes the goodwill calculation, it changes the net assets that you're acquiring, etc. So I'm just saying to you, if you think that this basis approach has no impact, it's wrong. It has a tremendous impact in certain types of transactions. So in a merger deal, you need to use the basis approach. And that's why we went to this approach as well. Okay? All right, so that's the basis approach. That's the approach you have to use. In fact, you're never going to see, let's go to this example on page 3. You're never, ever going to see expenses mentioned in a footnote. You'll always see it the following way. This for Crocs. Tells you that when you account for income taxes using the asset liability method, which requires the recognition of deferred tax assets and liabilities for expected future tax consequences of temporary differences between the carrying amount and the tax bases. So you notice they didn't say it's the difference between expenses and revenues. They said it's the difference between the carrying amount and the tax bases of other assets and liabilities. They provide for income taxes at the current and future enacted tax rates, which we'll do in a second. So you always have to think about deferred taxes in terms of the carrying value of the asset for book purposes and the tax basis. It's got to be done this way. And we will survive with an income statement approach, but you always have to convert that to a basis approach at some point. Now, once again, a little bit of a memory jogger or rubric. This will also help you with the notion of the basis approach. So again, the one we've just been looking at If the tax basis is lower than the book basis for plant assets, you got a deferred liability, right? If the tax basis is higher than the book basis for an asset, an example would be bad debt. Allowance not being deducted for tax purposes means your accounts receivable are higher for tax, gives rise to a tax asset. Now, I would ask you to read through those scenarios. As I said, and it depends, and my objective is to make sure you understand this as well as you can. Exam-wise, you could always look at a problem and get it right, but these scenarios will help you understand the interpretation of the basis difference. And I've got some examples in there. I think if you read it once, a couple of times, it's going to make it a little bit easier to understand the basis approach. Okay. Now, the basis approach goes a little bit further, and I said those scenarios you can look on your own. When we look at tax rate changes and the classification of those items. Also, we're going to get to tax rate changes in a second, but deferred tax assets, this is going to be something that's going to be critical because, let me just give you a little bit of a background on deferred tax assets. Now, there's an example right below that I'll ask you to work on if you want to use it as an illustration. Not something we're going to do because we'll cover deferred tax assets in detail when we look at net operating losses. But first, let me tell you about a deferred tax asset. When you have a deferred tax asset, in order for that asset to have value, the first thing you have to realize is that a tax asset is a future deductible amount. It includes future tax deductions. In order for those tax deductions to be valuable to you, you have to have income. Now, just think about the SEC looking at this, and they would say, okay, if I allow companies to report deferred tax assets, it's going to signal to the market that they expect to have future taxable income, correct? Otherwise, the asset is useless. If taxable income is expected, book income has to be even what? Higher, normally. So the SEC originally made it very difficult to recognize deferred tax assets. And this was going around for a while, and we finally settled on the following. Under the FASB Accounting Standards Codification, the section is 740, deferred tax asset recognition is always allowed, but it's subject to an impairment test. The impairment test is going to involve looking at positive and negative evidence regarding future income. Positive evidence of future income would be a backlog of sales orders. I have this later on. We'll look at this when we do the NOLs. It could be a contract, a government contract. It could be changes in economic or industry forecasts. Negative evidence could be negative or downside economic forecast. It could be loss of a major customer. So all of that has to be weighed, and we use this criterion more likely than not. More likely than not means slightly more than a 50% chance, and this is going to come up over and over again. In fact, we saw this last semester when we looked at the goodwill impairment test. We said that you would start the goodwill impairment test, you would initiate a test for impairment only if it was more likely than not that you expected goodwill to be impaired. If not, you could avoid the test. Same thing's true here. Now, more likely than not, slightly more than a 50% chance. If any of you studied law, that's the criterion for a civil case. A criminal case is beyond a reasonable doubt. And when I was in school, we used to use beyond a reasonable doubt to recognize deferred tax assets. So they've lowered the threshold a little bit. But if a part of the deferred tax asset is impaired, it has to be reduced by a valuation allowance. And that's just like a bad debt. It's exactly the same as the bad debt expense. Now, the journal entry to record the bad debt expense is what? A debit to the bad debt expense and credit to the valuation. What entry would you use here? If I have a DTA and I need to put a valuation allowance on that, what entry would I make? What am I going to debit? What expense? Tax expense, right? Debit the tax expense and credit the allowance. Now, this is going to cause volatility in the tax expense. It's going to cause volatility in income, and it's going to cause volatility in the effective tax rate. Now, what if management says, oh, you know what? Made a mistake. Last year we thought we weren't going to get the income. Now we project that we're going to get the income. What's going to happen? To reduce the allowance, what would you do? You would debit the allowance account and you credit tax expense. So you basically increase net income by changing the allowance. Now, is there evidence, is there research that shows that managers smooth income by using the allowance? Yes. The valuation allowance for tax purposes could be used to smooth income. And it's done. Sometimes you see companies with very low effective tax rates. I've seen companies, there was a Canadian company changing their valuation allowance that had an effective tax rate, I think, of 5%, right? Because again, this will lower the tax expense if you reduce the valuation allowance. So once again, the whole idea of the balance sheet approach is to properly value the tax asset and liability, and this will cause volatility in the entity's effective tax rate and, of course, their net income. All right, now, to see this, we're going to wait until Thursday for the NOL to cover the tax asset and the valuation allowance. I'm not going to cover this illustration. I want to go right to the tax rate change. So if you go to same example we've been using, and this is on page 8, tax rate changes. And once again, same illustration. Let me get that up on the screen. Anytime there is a tax rate change, number one, it has to be enacted into law. Well, first of all, let's go back for a second. I'm sorry. Let me make sure that you see this first. Something if I didn't say this earlier, we should make sure this is clear, that you measure deferred tax assets and liabilities at the tax rate that we expect to be in effect at the reversal date. Now, that does not mean we forecast what taxes will be. It means that we think about what income level you're going to be at with the existing tax code. So right now, if you were looking at that pension example I gave you, right, when you take money out of your pension plan, what tax bracket are you going to be in? If you're in a 28% bracket now, when you retire, you might be in a 15. That's the rate you use, the expected rate that will be in effect when you retire. You cannot try to project what future tax rates are going to be. But if a tax rate change is enacted into law, we have to revalue all of our deferred tax assets and liabilities. That revaluation is a prospective adjustment. So just make sure you note that this is a prospective adjustment. It's a prospective adjustment. That means that we don't change prior years. We only go forward with that tax rate change. Now, tax rate changes, again, as I showed you, we'll go through the tax line, and that's going to cause volatility again. Another thing to note is for IFRS. IFRS is the same thing, except they say that the tax law has to be substantially enacted? And what does that mean? Well, under U.S. GAAP, if Congress passes a tax bill on a Friday and the president doesn't sign the bill for another 2 weeks, we can't use the new law unless it's signed into law. Under IFRS, if their parliament or their legislative body passes a tax change, even if the prime minister doesn't sign off on it, it's still going to be used for accounting purposes. And again, this could overlap accounting periods. So under U.S. GAAP, it has to be enacted. A small point, but it could become significant depending on the timing of the actual tax law. All right, so now, I'm going to take my base example. And once again, our base example said we had income of $400,000, constant income. We had straight line for book of $50,000 a year. We had a tax rate of 40%. That rate is now going to drop to 35% in year 4. The same numbers we had earlier. So that if we once again look at our depreciation, same table we had before, and up on the screen, I'm going to just leave this for now. This is all at 40%. Now, here's the problem. If we look at the liability on our books at the end, I'm going to highlight that in green, at the end of the 3rd year, that liability is $25,440. That is on my books right now. If you go back to the T accounts, the same number we've been looking at over and over and over again, $25,440 is the liability. According to prior GAAP, we didn't care. That came in at 40%, we use FIFO, we'll take it out at 40. That was an income statement perspective. Now, under the balance sheet approach, here's the way we look at it. That liability is overstated. So, once again, we're trying to give credibility to deferred taxes. I think I mentioned that early on, most analysts, in fact, probably today, if I went back, actually I'm doing one this summer, another investment bank training, I'll go in there and I'll talk to these analysts, and they'll tell me, it's a plug. The deferred tax is a plug. It's not a real liability. But the accounting profession is trying to give it some credibility, so we're saying that liability, when it is paid back, is overstated. Because when you pay it back, you're not going to pay it back at 40%, you're going to pay it back at 35%. So what you need to do is take the cumulative book tax differences. So if you look at these book tax differences, the cumulative amount, and we go down, the cumulative book tax difference is 63.6. The cumulative book tax difference is 63.6. And let me just show you on the screen, if we go to the current number, 63.6 multiplied by 40% gives you the 25,440 as your liability. It's overstated. It should be 63.6 multiplied by 35%. The liability should not be on the balance sheet at 25,440. It should be on the balance sheet at 22,260. And the difference is 3180. And that's the adjustment we have to make. We basically need to write the liability down by 3180. Now, you can do it a couple of ways. That I happen to like this way because it shows you how the liability was created and what it should be. The shortcut that you can use, let me just scroll down for a minute. Shortcut is right here. Just take the cumulative book tax difference times the difference in the tax rate. of 5%. That's another way to get to 3180. In any event, you have to reduce the liability. The liability is overstated. The liability is overstated. So under the balance sheet approach, we want to make sure the liability is correctly stated. And of course here, right, where it say alternatively, that's exactly what I'm doing up on the board. It's the cumulative book tax difference multiplied by 40%. That was the overstated or the original liability. The corrected liability is at 35% or 22,260. Now, any questions on that adjustment? The first thing I'm going to focus on is this adjustment. Any questions on the adjustment? Something you have to be able to do. Yeah, so.
Do you report the adjustment when the tax rate changes, or when you're reporting it from the tax?
All right. As soon the beginning of the year in which the tax rate is enacted into law, I'm assuming an annual report, even if it's quarterly. This summer, if you do quarterly reports, you'll find out that you would have to go back and restate those quarters as well to get the new tax rate. So, yeah, you would go back to the beginning of the year. All changes take place at the beginning of the year of which it's enacted. And the entry, incidentally, I'll tell you, is I would make a separate entry here. We have that later on, but you notice that the entry is going to debit the liability. I'm going to put this on the screen in a second. It would debit the liability and credit tax expense. It flows right through the tax line. Then, of course, if you look at the regular provision, you still have to do your regular reversal. Your regular reversal is 15,440, which, let me go back to that amount for you. It's the book tax difference times the new tax rate at 35%. And then, of course, the next year, you get the same reversal. And finally, in year 6, it reverses out at 35%. Same reversals we had before, but they're reversing at 35% now instead of 40. And, of course, we get the 0 at the end, which we would expect. And let me show you the entries, and we'll take some questions. The journal entries, of course, we have the tax return, so sorry, I forgot that. This expense, of course, is the MACRS depreciation, which we've been working with, same numbers we had before. Something to notice, and I shouldn't have jumped over that so quickly, because in years 1, 2, and 3, you're being taxed at 40%. Year 4, 5, and 6, you're taxed at 35% because the tax rate changed. Now, you don't need to do anything for the prior years because you paid tax at 40. The government's not going to say, all right, well, now the tax rate changed, we're going to lower your prior tax. No, not going to change. So we don't have to change the payable. So these liability numbers are not going to change, except that they're 35% for years 4, 5, and 6. For GAAP purposes, it's going to be, again, the current provision, 136 plus the deferred, and of course the deferred provision. Let me go back to what I had up there earlier. You should remember that this deferred provision comes from the original table. That's the book tax differences times the tax rate at 40%, and then we're going to change it now to 35, obviously, for years 4, 5, and 6. But for the first 3 years, those are the original depreciation, the original book tax difference numbers. In year 5, you're now going to get a difference because now we're calculating these reversals are coming out at 35% now. So again, in year 4, 5, and 6, the reversals come out at 35%. And the difference in year 3 is that you have the adjustment as well. so that when you calculate the tax provision in year 4, year 1, 2, and 3 is the same at 40%, but in year 4, you've got the adjustment of 3180 plus you have the regular reversal. Now, here's something I wanted to be sure that you see, that this may not look like anything too significant, but it is. Because if we want to do an effective tax rate, it's income tax GAAP expense over pre-tax GAAP income. And we know that pre-tax GAAP income, if income before tax and depreciation is always 400, if depreciation is 50, that's constant at 350. So the effective tax rate is 40%. In years 5 and 6, the effective tax rate is tax expense based on GAAP of 122.5 over GAAP income. Does everyone remember the GAAP income has to be constant at 350 in this example? Right? Because my assumption is that income stays constant at 4 and depreciation is always going to be 50 on the straight line. Anyone have any questions about the pre-tax GAAP income of 350? Okay. So that means that the effective tax rate in years 5 and 6 is going to be 35. Now, in year 4, which is highlighted, the problem here is the tax rate change results in volatility. The effective tax rate, although not that significantly different, is 34.1. The difference between the 35% and the 34.1 is part of that footnote reconciliation we'll look at in just a moment, but it is caused by the 3180. If you take the 3180 and divide it by GAAP income, you get the effect or the impact on the effective tax rate of 0.9. Now, in a footnote, you have to explain this to the reader, because the reader is expecting what? 35%, and you're showing them 34.1, and as a result, you would have to show in a footnote that the change in the tax rate caused the effective tax rate to be lower. Now, once again, people that are in finance or have taken finance courses understand that now hopefully you know that when you look at a financial statement and you take a tax rate and you multiply it by income to get tax expense, you're using the effective rate. You're not using the statutory income tax rate. In other words, if you took 35% of book income, you'd have a problem. You'd get 122.5, and yet it is what? 119,320 in this year. Okay. So the effect of the tax rate change is to result in volatility in the effective tax rate. Okay, so are there any questions on tax rate changes? Okay, as I said, we will see on Thursday, we will see the effects of the valuation allowance and the deferred tax asset. Okay. All right, now, let me just show you the journal entries, just so we're sure on this. All right, so the journal entries, let me move this up again. All right, so the journal entries, I would make 2 entries. Let's move this up one more time. Still can't get it. Want to get it all on one page. Just give me a second. Okay. So first I would make the adjustment for the tax rate change, and I would debit the deferred liability and credit the income tax expense. So that would be the first entry I would make in year 4. Remember, it's the year 4 journal entries. And then I would have my regular tax provision where I would debit tax expense, 122.5, debit the reversing, and once again, there's a reversal in that year, which is the book tax difference that reverses out of $15,440 times the tax rate of 35%. That's $5,404. And credit the payable. Now, you're in a reversing period, so therefore, when you pay the government $127,904, you pay them for current economic activity, which is the 122.5 tax on that current economic activity, plus paying back the previously deferred liability. So you pay it back, and by the way, you're paying it back at 35%, and that's why the tax rate change is implemented early in year 4 so that the deferred liability captures that correct amount. Okay. All right, so that is another aspect of the basis approach. Now, we're going to do 2 other things. We're going to look at classifications of deferred taxes and look at permanent differences. And then on Thursday, we're going to move into net operating losses. But for now, before I go into the classification, anyone with any questions on this, anything, on the tax rate change? Okay, so anytime a tax rate changes, you can use either approach. You could take the cumulative or the approach on the full amount of the liability, or just take the change in the tax rate. But whatever approach you use, that adjustment has to be made in the year of the tax rate change. Okay. All right. One other issue with this balance sheet approach is the classification. So if you think about classifying, you typically classify based on what? 1 year or operating cycle is current, more than 1 year operating cycle is non-current. That's not going to happen here. Unfortunately, we've got classification rules that are somewhat convoluted, and it's done for really a cost-benefit rationale, which I'll explain to you. Here in A is the most common way we classify deferred taxes. Deferred taxes are classified as current and non-current based on the classification of a related account. Now, what's a related account? A related account is an account which its balance would change, and that would trigger a reversal. So, for example, if you look at straight line for book and accelerated for tax, as you depreciate the asset, the planned asset declines, that causes reversal. If the planned asset is causing reversal of a deferred liability, what's the classification of the planned asset? Current and non-current? Non-current. Plant assets, property, plant, and equipment. Therefore, the liability for deferred taxes is also non-current. So you tie the classification of the deferred tax to the underlying account. If a related account or an underlying account does not exist, as it is in B, if it does not exist, then you would use a 1 year or operating cycle for current, more than 1 year operating cycle for non-current. And we'll get to that when we do the net operating loss. Now, let me give you an example. What you should know is that the presentation on the balance sheet is a result of looking at many book tax differences. Accountants will take all of the book tax differences, classify them as liabilities, deferred tax assets. Some of those will be current, some of those will be non-current. On the balance sheet, you could net assets and liabilities. Deferred tax assets and deferred liabilities could be netted if the right to offset exists. And what's the right to offset? A deferred liability and a deferred asset for the federal government. Where does the right to offset not exist? A New Jersey deferred tax asset cannot be offset against the federal deferred liability. You can't net them out. It's only if the taxes are due to the same jurisdiction. So what will happen is we'll take hundreds maybe of deferred tax assets and liabilities, classify them. When the right to offset exists, we'll net them out. If not, we'll show them separately on the financial statements. Now, let's go to an example. We have a company that's got 4 book tax differences, 2 DTAs, 2 DTLs. We have an $80,000 deferred tax asset for a 1-year subscription. That means that there is a advanced collection, which is immediately taxable, gives rise to future tax deductions. Warranty, can't deduct it right now. Got to be a tax asset. 1-year warranty. Depreciation, deferred liability. Why? Well, you've got accelerated for tax, straight line for book, and another DTL, installment sales used for taxes. On our books, we decided to use the accrual basis. We recognize the full amount, cash basis used for tax purposes. So here's what we need to do. We first look at the advanced collections. There's an $80,000 DTA. The underlying related account is unearned revenue. If that is current, the DTA is current. Straight line, depreciation for book, accelerated for tax. A 320 deferred liability. The underlying account is a plan asset. That asset is long-term. DTL is long-term. Warranty, deferred tax asset. We accrue the warranty liability for books. We have to use a cash basis for tax, meaning that we cannot recognize the warranty expense until we actually pay it. Deferred tax asset, if it's a 1-year warranty, current liability, the estimated warranty liability is the underlying liability, the DTA is current. Installment receivables that we have, we accrued it for book purposes but use a cash basis for tax. We paid less tax today. We have a DTL, but since this is part of normal operations, if installment sales are part of normal operations, that receivable is going to be current, and as a result, the deferred tax account is also current. Now, assuming the right to offset exists, it means that we're going to take $80,000 in the DTA that is current. We're going to take the current DTA of $8,000 and offset it against the current DTL. That means we're going to have on our balance sheet. So if we look at the balance sheet, under current assets, you have a DTA of $26,000. You were able to net these out because the right to offset was assumed to exist. All of these, let's say, are from New Jersey. Then you have a DTL on your non-current liabilities. You have the DTL, and that's going to be for 320. So the balance sheet presentation would show a net DTA of 26 and a deferred tax liability of 320. Now, again, other combinations could exist. What would you do if, let's say hypothetically, I told you that the deferred tax assets were from New Jersey and the installment sales were taxed in New York State? What would you do on the balance sheet? Yeah, you can net it out, so what will happen is the New Jersey asset of 88, oops, let me get rid of this one too. It's going to show up here. And then under current liabilities, you're going to have the 62,000 DTL of 62. That just assumes the right to offset does not exist. Yeah, so this would be in a different state and you couldn't offset it. Or this could be federal, that could be New Jersey. You can't offset them. Now, I've seen companies offset and net them, but they have disclosures that, but technically this is what you're supposed to do on the balance sheet. Okay. All right, so that's your classification. Again, nothing too difficult, but just something a little different or unusual, I think, that we want to be sure that you are aware of. And one of the last, we're going to do permanent differences in just a second, but one of the last, I guess, memory or rubrics to look at. Again, a lot of people have trouble building the tax provision, so I put this in. Again, I want you to understand as much as possible. You need to remember that the tax provision itself, the expense, is a debit. The change in the payable, the current provision, is a credit. When you increase a deferred liability or decrease a deferred tax asset, you're going to be increasing income tax expense. Relative to tax payable. And when you pay off the liability, or if you increase the DTA, you actually reduce tax expense. You pay more, but you reduce the tax expense. So again, a lot of people like these flashcard kind of things, so I throw them in. I know it helps, and that's why they're there. All right, so now, with all of this, we're going to do permanent differences in a second. What I would hope that you would be able to do is make sure you read through this, look at all the scenarios, take a look at all the examples, try to understand as much as possible, because by understanding it, any unfamiliar looking problem, homework assignment, exam question, CPA exam question, client situation is going to, and even if, you know how it is, if you did an internship, a lot of people just go in, talk to the senior, 1, 2, 3, you go out, oh geez, I should have asked them, or I should have, talked to her a little bit longer. But sometimes, it's much better to go in there with a full understanding of what you're doing. So this will come up, I don't care what business you're looking at, aside from not-for-profit organizations or governmental agencies, you're still going to be, no matter where you are, what size firm, this is going to be a major issue. This will also come back to haunt you no matter what you do in business. It's a critical issue. What we're doing these last couple of weeks are, taxes and EPS and the pensions are the three biggest topics, I think, in financial. Okay. All right. Our last issue is going to be permanent differences. And so far, we've looked at only temporary book tax differences. So far we've looked at temporary differences, items of revenue and expense that appear on your income statement in a different period than they appear on your tax return, right? Because eventually they're going to be on both sets of books. Permanent differences are very different. These are items of revenue and expense that will be on your tax return, never show up on your books, or they'll be reported for GAAP, but never show up on the tax return. Now, because they are not going to be on both sets of books, they're never going to reverse. If they're not going to reverse, they're not going to be deferred. So you don't need to worry about deferred taxes when you've got permanent differences. Then what is the role of permanent differences? Well, we'll see. You need to reconcile the difference between the federal tax rate and the effective tax rate, and permanent differences become major reconciling items. Now here are some examples. Tax-free interest. You know that it's income on your books, but it's not taxable. Insurance expense for officers' life. Every major company has a policy on their CEO, and those premiums are not tax deductible. They're expenses. The death benefits, by the way, are not taxable. Compensation expense for qualified options. There is no expense deducted for qualified options. So we know that we expense them. We did that on the exam. If you did that question, you debit comp expense, credit deferred comp, or APEC options. That expense never shows up on your tax return. In addition, there is a host of others. I mean, fines and penalties, government fines and penalties, not tax deductible. If you don't pay your taxes on time and they impose a penalty, you pay it, it's not tax deductible, and it's an expense on your books. Now, if permanent differences are not deferred, their role is in this reconciliation of the effective tax rate, or the federal tax rate to the effective. Now, here's an example. You've got, let me put this up on the screen for you. You've got income for GAAP purposes of $70,000. In that $70,000, it's on page 13. In that $70,000, you've got a $9,000 tax-free interest. So your taxable income is $61,000, and at a 40% tax rate, your tax liability is $24,400. Now, if I wanted to build the deferred provision, the tax provision, income tax expense, this is the change, obviously, in income tax payable, not the balance. And plus or minus the deferred provision, that's also the change in the deferred tax account. Just to make this clear, it's the changes, because it's an income statement, it's a flow. In this problem, I assume that there are no temporary differences. If there are no temporary differences, are there any deferred taxes? No. So the deferred provision is 0. The change in the payable is $24,400. So my tax expense is $24,400. Now, I'm able to set the income tax expense equal to the tax payable because I don't have any deferred taxes. Now, here's where, again, I want you to be sort of like, very cognizant of the fact that you cannot always multiply book income by the federal rate. If you multiply book income by the federal rate, 70 times 40 is 28,000, and that's not tax expense. So you just can't take a federal tax rate and multiply it by GAAP income. And I see people make this mistake constantly. So you have to remember. Now, of course, at some point, when you become very comfortable, if you knew that you didn't have permanent differences, you could do that. But when you got permanent differences, when you got tax rate changes, when you've got changes in deferred tax account allowances, it is not, you're not able to take that tax rate. Now, what is the, you can use the effective tax rate. If I know the effective tax rate, I can multiply it against 70 and get that number. What is the effective tax rate? Well, in this case, we're going to find out that it's 35%, and the footnote that is required, and by the way, you have to know how to do this footnote. This is a required footnote for publicly traded companies. For smaller companies or non-publicly traded companies, privately held companies, you only need to describe the permanent differences of the reconciling items. This reconciliation can be provided in dollars or percentages or both. I'm always going to ask you for both. And the reconciling items include permanent differences, state and local taxes, because don't forget, this is, and that should have been clear here, this is, I don't know if I put it on yours, but this is the federal rate. So, I guess I didn't. The federal rate is 40%. Now, your effective rate changes by what else? State and local taxes, foreign taxes. State and local taxes are reconciling items. They change your effective tax rate. Foreign taxes change your effective tax rate. Changes in tax rate change the effective tax rate. Deferred tax asset allowance account changes change that. So there's an entire list of reconciling items. I'm going to show you some footnotes, but there are lots of reconciling items. What you see here, the tax-exempt interest, is a permanent difference. That's the reconciling item we're looking at right now. So if I were to tax $70,000 at the federal rate, I would have had a tax expense of 70 times 40% or $28,000. That is what an analyst would be looking for. So a reader looks for $28,000. They don't find it. They go to the footnote to find out why. They find out you had tax-exempt interest, and that tax-exempt interest saved you $3,600, and it brought the tax rate or tax amount to 24.4. And this is what you find on your income statement. So 24.4 is what you find on the income statement. Now, to do it in dollars, very simple. You divide everything by 70,000. You would take the 28,000 gap, I should say tax at the federal rate over 70. That gives you 40%. You would take the 3,600 savings on the tax-free interest, divide that by 70. You get 5%, and you get the effective tax rate by taking 24.4 divided by 70. Now, again, that is the effective rate. So let's go back to a financial analyst or what some people think. If you knew 35%, you can have all the fun you want with that number. You can multiply it against the GAAP income. That will give you the correct tax expense. You cannot use the federal rate when you've got reconciling items, and in particular when you've got the permanent differences. Okay? So that footnote is, again, a critical disclosure for the analyst. So now the analyst sees how we got the 24.4 and how we got our effective tax rate. So that has to be explained. And there is a, I guess it's part of the FASBIC, a standards board for smaller companies. It's big gap, little gap, and for smaller companies, or I should say, for publicly, non-public companies, you would only need to show a description of the reconciling items. You don't have to show the numbers. So private, anyone here, if you're doing PCS or private company services or non-publicly traded companies, you'll find out that that disclosure is only in terms of the description of the items. You don't need to show the numbers. You could if you want, but you don't need to. All right, and finally, one of our, I guess, last rubrics is that if you only have temporary differences, I will tell you that it, of course, will impact the deferred taxes, but it won't change your effective tax rate. Right? As long as there are no permanent differences or other adjustments, straight up, all you're going to have is an impact on your effective tax rate, impact on your deferred taxes. If it is permanent, it doesn't change the deferred taxes, as we've shown here. And that's why I isolated it this way. Right? So when there are only permanent differences, no impact on deferred taxes. However, it does change your effective tax rate. Right? So once again, just a sort of a flashcard kind of table that you can look at to make sure you have this straight. Now, once you get comfortable with this, if you have a problem and you see there are no permanent differences and no other adjustments, then you can go right ahead and use the federal tax rate on all the numbers and you'll be correct. If you know there are permanent differences, then you know you have to build the provision this way, all the way through. All right, so now, let me tell you what we're doing for the remainder of the class. We have 3 left, plus the final. And I guess we can